Hello, my dear students. Today I am here with you to discuss CMA Inter Direct Taxation June 2025 attempt MQP 1. So, let us discuss MCQs first, then I am going to discuss problems very clearly. So, watch till the end to know all the answers. See, here answers are given for MCQs, but the derivation, how the answer came, that is not given. That I am going to show you. Okay, let's quickly start. Which of the following is an agricultural income? Dividend paid by a company out of its agricultural income. Such dividend is not an agricultural income. Share of profit of a partner from a firm engaged in agricultural operation. This is agricultural income. I think this is the answer. Income from supply of water by SSE from a tank in agricultural land. This is also non-agricultural income. Interest received by money lender in the form of agricultural produce. That is also non-agricultural income. So, like if a partner of the firm gets his share of profit from partnership firm, it is treated as agricultural income in the hands of partner and it is not taxable. Next, Mr. Pratik, aged 48 years and a resident in India, has total income of 650 lakhs, comprising long-term capital gain taxable at the rate of 20% under section 112, short-term capital gain taxable at the rate of 15% under section 111A 65 lakhs, other income 530 lakhs. What is their tax liability under default tax regime? First of all, let me write all the incomes. Long-term capital gain under section 112 taxable at the rate of 20%, how much? 55 lakhs. Short-term capital gain under section 111A taxable at the rate of 15%, which is 65 lakhs. Other income is 530 lakhs. So total income is 650 lakhs. We need to calculate the tax liability. Shall we calculate tax liability? First, tax on special tax rates. So tax on long-term capital gain under section 112. How much? 55 lakhs into 20%. It is 11 lakhs. Correct. Next, short-term capital gain under section 111A. How much? 65 lakhs into 15%. How much? 9,75,000. Total it is 20,75,000. Now, tax on other income being 530 lakhs. Up to 3 lakhs, tax amount is nil. Greater than 3 lakh, up to 7 lakh, tax rate is 5%. Tax amount is 20,000. Greater than 7 lakh, up to 10 lakh, tax rate is 10%. Tax amount is 30,000. Greater than 10 lakh, up to 12 lakh, tax rate is 15%. Tax amount is 30,000. Greater than 12 lakh, up to 15 lakh, tax rate is 20%. Tax amount is 60,000. Above 15 lakh, tax rate applicable is 30%. 530 lakh minus 15 lakh into 30%. How much? 1 crore 54 lakh 50,000. So how much is tax on other income? 1 crore 55 lakh 90,000. So how much is tax? 1 crore 55 lakh 90,000 plus 20 lakh 75,000. 1 crore 76 lakh 65. To this we need to add surcharge. See, total income is 650 lakhs. Total income has long-term capital gain under section 112, 112A. So for these two incomes, maximum you can apply 15% surcharge rate. Am I correct? Next, other income is there. For other income, surcharge rate is 25% because we are calculating under default tax rates. Under default tax rates, if total income is more than 5 crore, surcharge rate applicable is 25% or 15%. Whichever is higher means 25%. So for tax on incomes taxable at special tax rates, we will apply 15% surcharge rate. For tax on other income, we will apply 25% surcharge rate. So on 20,75,000, we will apply 15% surcharge rate. On 1 crore 55 lakh 90,000, we will apply 25% surcharge rate. So surcharge 20 lakh 75,000 into 15%, 1 crore 55 lakh 90,000 into 25%. So 20 lakh 75,000 into 15%, how much? 3 lakh 11,250. 1 crore 55 lakh 90,000 into 25%, how much? 38 lakh 97,500 plus 3 lakh 11,250. 42 lakh 8,750. So how much is tax plus surcharge? Tax plus surcharge is 2 crore 18 lakh 73,750. To this we need to add HEC at the rate of 4%. How much? 8 lakh 74,950. So total it will be 2 crore 27 lakh 48,700. That is the, you can see, this is the answer. Which of the following receipt is taxable under income from other sources? Uncommuted pension received from ex-employer. From past employer, if any benefit is received, it is taxable under salaries. Rental income from house property, taxable under house property. Income on transfer of rural agriculture land. Rural agriculture land is not a capital asset. No capital gains will arise. Nothing is taxable. Income from raising establishment, that is taxable under other sources. So this is the answer. While computing taxable interest on delayed compensation, a standard deduction. See, we have studied, if any compensation is received from government for compulsory acquisition, on such compensation, that is taxable as full value of consideration under capital gains. If any interest is received on compensation, interest on compensation is taxable under other sources. Total interest is not taxable, 50% deduction is allowed, balance 50% is taxable. So answer is 50%. When income of minor child is clubbed, SSC will get deduction of 1032. How much is deduction under section 32? Clubbed income or 1500, whichever is lower. If income clubbed is more than 1500, 1500 is allowed as exemption under section 1032. If income clubbed is less than 1500, in such a case, total income clubbed will be allowed as exemption under section 1032. So income clubbed subject to a maximum of 1500 per child. That is the answer. TDS is not required to be deducted under section 194A if the amount of interest on loan does not exceed. See, under 194A, what is the threshold limit? If interest is up to 5,000 rupees, no TDS is required to be deducted. If interest amount is more than 5,000, TDS is required to be deducted. So threshold limit is 5,000. Next. Now let us discuss questions. This question is from residential status. Ram provides following details of income. Calculate income which is liable to be taxed in India for assessment year 25-26 assuming. See here, list of incomes are given. We need to tell how that income is taxable for ROR, RNOR and non-resident. Salary received in India. The moment it is received in India, it is Indian income. If it is Indian income, it is taxable for all. Income from tea business in Nepal being controlled from India. This is foreign agricultural income. Foreign income from business, agriculture controlled from India. This is taxable for ROR as well as for RNOR. For non-resident, it is not taxable. Interest on company deposit in Canada. How much is interest on deposit? Interest on deposit 30,000. Out of 30,000, one third received in India. The moment it is received in India, it amounts to Indian income. If it is Indian income, it is taxable for all. It is taxable for ROR, RNOR as well as for non-resident. Two third received outside India. Correct. So if two third is received outside India, it is deposits in Canada. That means place of accrual is also outside India. It will be treated as foreign income. Foreign income is taxable for ROR. ROR global income is taxable. For RNOR, foreign income is taxable only if it is from business controlled or profession set up in India. So in case of ROR, 30,000 is taxable. In case of RNOR, non-resident, 10,000 is taxable. Profit from business in Mumbai. Business is in Mumbai. Place of accrual, Mumbai. It is Indian income. If it is Indian income, taxable for all. Profit for 22-23 from a business in Tokyo remitted to India. Past year profits brought to India in current previous year. Not at all taxable. Earlier year profits brought into India in current previous year. In current previous year, they are not taxable. It merely amounts to transfer of funds from foreign bank account to Indian bank account. It will not be considered as receipt of income. Property in India, place of accrual India. If property is located in India, place of accrual India, it amounts to Indian income, taxable for all. Property in London, received in Delhi. If place of receipt is in India, Indian income, taxable for all. Property in London, received in Canada. Property located in London, received in Canada. Both are outside India. It is foreign income. Foreign income is taxable only for ROR. Business in Zambia but controlled from Turkey. Both are outside India, right? Zambia, Turkey. So as both are outside India, it is foreign income. It is taxable only for ROR. Are you able to understand? Mr. Bharat of Siliguri is offered an employment by Vimal and Co. Limited, Kolkata, on a basic salary of 5,500 per month. Other allowances are dearness allowance not forming part of retirement benefits, 4,000 per month. Medical allowance 1,000 per month and bonus being 1 month's basic salary. The company gives an option to him either to take rent-free accommodation in Kolkata of fair rent value of 1,000 per month or to accept a cash house rent allowance 1,000 per month. He decides to accept house rent allowance and take house in Kolkata at a monthly rent of 1,000. See two options, either to go for rent-free accommodation or to choose house rent allowance. Out of these two options, one we should choose. Okay. Rent-free accommodation, HRA. Now we need to calculate salary if rent-free accommodation is chosen. We need to calculate salary if HRA is chosen. Based on that, we need to take the decision. First of all, how much is basic salary? Basic salary is 5,500 per month. Basic salary. 5,500 into 12 months. How much? 66,000. DA forming part of retirement benefits, 4,000 per month. 4,000 into 12 months. How much? I am sorry, here DA is not forming part of retirement benefits, 48,000. Next, medical allowance is fully taxable, right? Medical allowance, 1,000 into 12 months, 12,000. Next, bonus is 1 month's basic salary. 1 month basic salary means 5,500. Am I correct? Now first let us do HRA, then we will do rent-free accommodation. How much is HRA received? HRA is 1000 rupees per month. ₹1,000 per month. So HRA received 12,000. From this, we are going to claim exemption under section 1013A. What is the formula? Rent paid minus 10% of salary. How much is rent paid? 12,000. 1,000 per month, 12 months, 12,000. 10% of salary means for HRA salary means basic plus DA. Here basic is 66,000. DA is not forming part. You should not consider. 66,000 into 10%, 6,600. Balance 5,400. Or Kolkata, 50% of salary. How much is 50% of salary? 66,000 into 50%, 33,000. Or actual HRA received. How much is actual HRA received? Actual HRA received is also 12,000. Whichever is lower means 5,400 is exempt. So how much is taxable HRA? 12,000 minus 5,400. Taxable HRA is 6,600. In Kolkata, population is more than 40 lakhs. So for rent-free accommodation, taxable value is equal to 10% of salary. For the purpose of rent-free accommodation, salary is equal to basic DA not forming part, you should not consider medical allowances bonus. How much is salary? 66,000 plus 12,000 plus 5,500. The taxable value of rent-free accommodation is equal to 83,500 into 10%. How much it will be? 8,350. So how much is salary? 66,000 plus 48,000 plus 12,000 plus 5,500 plus 6,600. 138, 100. 139, 850. Where salary is low? Salary is low for HRA. So it is beneficial to choose HRA. Did you understand? I think that's the answer. So it's beneficial to go ahead with HRA. Next. Same problem which we have already discussed in house property. Same, this type of problem. I'm teaching exam oriented batch. In exam oriented batch, same problem I have discussed. Two brothers, Virat and Rohit, are co-owners of a house property with equal share. Property was constructed during financial year 16-17. Property consists of 8 identical units and is situated at Kerala. So there is a house property. That house property consists of 8 units, 2, 4, 6, 8. And this is co-owned by Rohit and Virat. Ro and Virat. During 24-25, each co-owner occupied 1 unit of residence. Let's say this is self-occupied by Virat. This is self-occupied by Ro. Remaining all six units are let out property. They are let out for 12,000 per month per unit. So the municipal value of the house is 10 lakhs. Municipal taxes are 20% of municipal value, which were paid. Municipal taxes are paid, so they are allowed as deduction. Other expenses are as follows. Repairs, whether actual repairs allowed? No. Insurance premium allowed? No. Actual expenses are not allowed. In place of actual expense, standard deduction is allowed. Interest payable on loan taken for construction of house. This is allowed as deduction under 24B. One of the let out units remained vacant for 4 months. What do you mean by this? out of 6 units, 5 units were let out for 12 months. 1 unit was let out only for 8 months. For 4 months, it is vacant. So, how much is actual rent? Actual rent is equal to 5 units into 12 months into 12,000 plus 1 unit into 8 months into 12,000. So, how much is actual rent? 8,16,000. Correct. Actual rent is 8,16,000. Well and good. Fair rent. How much is municipal rent was also given here. Municipal rent is 10 lakhs. But 10 lakhs is for 8 units. How much is for 6 units? 10 lakhs divided by 8 into 6. 7 lakh 50,000. So step 1, fair rent or municipal rent, whichever is higher. Fair rent not given, municipal rent 7.5 lakh, whichever is higher means 7.5 lakh. Step 2, result of step 1 or standard rent, whichever is lower. As it is not given, 7.5 lakhs is standard rent. Step 3, we need to compare actual rent with expected rent. Actual rent 8,16,000, expected rent 7.5 lakh. Actual rent greater than expected rent. So gross annual value is equal to actual rent, which is equal to 8,16,000. Are you able to understand? Okay. Now other incomes are given. Based on this, you can calculate the income. Gross annual value 8,16,000. How much are municipal taxes? 10 lakhs into 20% into municipal value 10 lakhs, right? 10 lakhs into 20% into 6 by 8. Why 6 by 8? Because only 6 units are let out. So 2 lakh into 6 by 8, it will be 1.5 lakh. How much is net annual value? Net annual value 8 lakh, 6 lakh 66,000. From this, we will reduce standard deduction 24A. 6 lakh 66,000 into 30%, 1 lakh 99,800. Next 24B, interest on borrowed capital. How much is interest? 3 lakhs. 3 lakhs is for 8 units. For 6 units, how much? 3 lakhs divided by 8 into 6. 2 lakh 25,000. How much is income from let out property? 2 lakh 41,200 divided by 2. 1 lakh 20,600 is for row. 1 lakh 20,600 is for Virat. So this is let out property. In case of self-occupied property, gross annual value nil, municipal taxes 0, net annual value nil, standard deduction not allowed. Only thing allowed is interest under section 24B. How much? 3 lakhs into 1 by 8, because only one unit is occupied. 3 lakh by 8, 37,500. So for Rohit, 37,500. For Virat, 37,500. Okay. So this is loss from self-occupied property. Am I correct? Let's check the answer. 1,20,600, 1,20,600. Loss is 37,500, 37,500. My dear students, please remember, if SSC is paying taxes under default tax rates, interest on borrowed capital is not allowed as deduction for self-occupied property. If SSE is paying taxes under optional tax rates, interest on borrowed capital is allowed as deduction for self-occupied property. Okay, keeping that in mind, balance you can solve the problem. I have told you how to calculate let out property, how to calculate self-occupied property. Balance problem you can do on your own. Next, from the following particulars of Sri Kote for the year ending 31st March 25, calculate his taxable income from business for assessment year 25-26. Opening stock, purchases, salaries, legal expenses, bad debts, rent, interest on loan, depreciation as per accounts disallowed. It will be added back. Income tax paid not allowed as deduction. Outstanding customs duty. See, government related expenses are allowed as deduction as per 43B. Only when it is paid, it is allowed as deduction. Here it is outstanding, not allowed as deduction. Advertisement, legal expenses, contribution to unrecognized provident fund not allowed, only to recognized provident fund if any amount is paid allowed as deduction. General expenses, traveling expenses. In computing income, following facts are to be taken into consideration. Interest on loan is paid to brother of Sri Kote for loan taken for payment of advance income tax. The loan taken for payment of advance tax. For such loan, if you pay any interest, such interest is not allowed as deduction. During the year 2021, SSC had claimed 45,000 as bad debts, out of which only 35,000 was allowed as deduction. So in previous year 2021, how much are bad debts? Bad debts are 45,000. Out of 45,000, 35,000 allowed, 10,000 disallowed. Expenditure disallowed. That means this 10,000 was added back in 2021. That means this 10,000 already taxed in 2021. Already taxed in 2021. Now how much is recovery of bad debts? Recovery of bad debts is equal to 25,000. Out of 25,000, already 10,000 got taxed earlier, minus 10,000, balance is 15,000. It is taxable now. Okay. Next, contribution to unrecognized provident fund, that is not allowed as deduction. Legal expenses include 2,000 paid for preparation of income tax return, that is allowed as deduction. Stock is undervalued by 10%. Okay. Opening stock 1,20,000. See, stock is should be valued at 100%, but it is undervalued. How much is undervaluation? 10%. So now it is at 90%. So whatever 1,20,000 closing stock is at, that is at 90%. Closing stock undervalued. What is rectification? To rectify it, we will increase closing stock. When we increase closing stock, income side increases. Automatically net profit increases. So if 1,20,000 is at 90%, how much is at 10%? Let's do cross calculation. 1,20,000 divided by 90 into 10. 13,333. So net profit should be increased by 13,333. Well and good. Next, opening stock undervalued. To rectify, what will we do? We will increase opening stock. When opening stock increases, expenditure side increases. When expenditure side increases, net profit decreases. So how much is, I'm sorry, hold on. Closing stock is 2 lakhs, right? I did a mistake. Hold on. Closing stock 2 lakhs. 2 lakhs divided by 90 into 10. 22,222. So net profit should be increased by 22,222. Opening stock. 100%, undervaluation 10%, balance 90%. Opening stock is at 1,20,000. Cross calculation. 1,20,000 divided by 90 into 10, 13,333. So net profit decreases. So we will decrease 13,333. So how much is net effect? 8,888. It should be increased. Am I correct? You can check the answer as well. So undervaluation of closing stock 22,000. Undervaluation of opening stock 13,333. So closing stock added, opening stock reduced. You can see 22,222, 13,333. I hope now you understood the adjustment. Gift received was given by a supplier for achieving target sale. This is taxable under PGBP, no problem. Outstanding customs duty paid on 31st December after ITR due date, not allowed as deduction. During previous year, he comes to know that his former employee had embezzled cash of 5,000 on 31st March 24, which was not accounted for. See, loss of cash. If it is claimed as deduction, good, but it is not accounted for. Now you will claim it as deduction. Okay. Traveling expenses include 50,000 being cost of trip to Singapore by employee for 10 days. However, only 8 days of trip is useful and 2 days has been allowed as holiday. See, he is going on a vacation. Sorry, he is not going on a vacation. He is going for business meeting. Out of 10 days, 8 days he attended business. 2 days he spent time there. So it can be considered as staff welfare expenditure and total 8 days are expenditure are allowed as deduction. Rent includes expenditure on extension of shed. Expenditure on extension of shed, capital expenditure not allowed as deduction. So 26,000 not allowed as deduction. Okay. It is to be disallowed. General expenses include salary paid to domestic servant. It is personal expenditure not allowed as deduction. Compensation of 2,000 paid for retrenchment of employee, that is allowed as deduction. Genuine expenditure paid to employee allowed as deduction. Next, on 23rd June 24, Rajat sold gold. Sale consideration 23rd June. That means before 23rd July 24. If it is before 23rd July 24, indexation benefit is available. He had acquired this gold on 20 August 2000 for 4 lakhs. See, this was acquired before 1st April 2001. If movable asset is purchased before 1st April 2001, cost of acquisition is equal to actual cost or fair market value as on 1st April 2001, whichever is higher. How much is actual cost? Actual cost is 4 lakhs. Fair market value as on 1st April 2001, 3 lakh 60,000. Whichever is higher means 4 lakhs. 4 lakhs is to be taken as cost of acquisition. So compute capital gains for assessment year 25-26. Also compute if such asset was transferred before 23rd December. See, first let us do case 1. Transfer before 23rd July 24. If it is transferred before 23rd July 24, indexation benefit is available. Full value of consideration. It was sold for 15 lakhs. You can claim indexed cost of acquisition as deduction. What is the formula? Cost of acquisition into cost inflation index in the year of transfer divided by cost inflation index in the year of purchase. How much is cost of acquisition? It was purchased for 4 lakhs, correct? 4 lakhs into year of transfer 24-25. Index number 363. Year of purchase before 2001. So index number is 100. 4 lakhs divided by 100 into 363, 14 lakh 52,000. So how much is long term capital gain? I think 48,000. Let's check the answer. Yes, long-term capital gain is 48,000. You can calculate tax liability. Before 23rd July 24, long-term capital gain under section 112, tax rate applicable is 20%. So 48,000 into 20%, you can calculate the tax. If it is transferred on 23rd December, 23rd December means after 23rd July. If it is transferred on 23rd December 24, full value of consideration 15 lakhs. Only cost of acquisition, indexation benefit is not available. Cost of acquisition 4 lakhs. So long term capital gain 11 lakhs. Tax rate is 12.5%. How much? 11 lakhs into 12.5%, 1,37,500. That is the tax liability. Okay. Mr. Jyoti received following gifts. Gift of sculpture worth 51,000. Sculpture falls under the definition of property. It is greater than 50,000. So it is fully taxable. Received a car from his cousin on payment of 3 lakhs. Fair market value 3,60,000. First of all, car is not a movable property. So whatever the car that is received, that is not taxable. Received cash gift of 20,000 each from 3 of his friends. 20,000 into 3. How much? 60,000 greater than 50,000. Fully taxable. Acquired office building on 12th December from his friend Raj for a consideration of 12 lakhs. Stamp duty value 15 lakhs. Stamp duty value minus actual consideration. How much is inadequate consideration? 15 lakh minus 12 lakhs. Inadequate consideration is 3 lakhs greater than 50,000. So 3 lakhs is taxable. Correct. Next. In respect of land, Mr. Jyoti acquired by government in the year 2015, he received following amounts. Interest on enhanced compensation. I discussed it in MCQ. Only 50% is taxable. And interest on enhanced compensation is taxable on cash basis. When it was received? 15 December 25. That means previous year 24-25. See, for which year it was received, not relevant. When it was received, that is relevant. When it was received, 24-25. So all are taxable in 24-25. How much received? 1,25,000 plus 1,65,000 plus 1,15,000. 4,05,000. From this 50% deduction, how much? 2,02,500. Balance 2,02,500 is taxable. Are you able to understand? Next, compute gross total income. Now, income from house property 60,000. Income from house property. Actually, this is loss from house property. Income from house property C. These are brought forward losses. Losses under section 22. Those are brought forward losses. So current year, how much is income from house property? Current previous year income from house property. How much? 2,60,000 minus, sorry, 1,60,000 minus 1,50,000. Current year income from house property is 10,000. How much are brought forward losses? 45,000. To set up, how much is brought forward loss under house property? 30,000. Out of 30,000, only 10,000 is eligible for set off. So brought forward loss 10,000. Current year income from house property is 0. Out of this 10,000, sorry, 30,000, 10,000 you can set off against current year income from house property. Balance 20,000 you will carry forward to subsequent years. Next. Loss under section 56. This is loss under income from other sources. My dear students, losses under the head other sources are not eligible for set off. They are not eligible for carry forward to subsequent years. This is last year loss from other sources. This cannot be carried forward to subsequent years. That is not possible. Loss under the head other sources, you can do intra-head set off, you can do inter-head set off, but you cannot carry forward to subsequent years. So last year brought forward loss under other sources, not eligible for set off. Okay, so only this 1 lakh is taxable income from other sources. Akhil 35 years provided following details relating to his income for previous year 24-25. You are requested to compute his tax liability and advise him he should opt for old regime or new regime. Income from business, this is taxable under TGBP. Income from savings, taxable under other sources. Deduction is also available under section 80 TTA, but only under optional tax rates. Okay. Interest on public provident fund, that is exempt, that is not taxable. Investment in public provident fund, this is eligible for deduction under section 80C. Under optional tax rates you can claim deductions, but under default tax rates you cannot claim deductions. So let us calculate optional tax rates, default tax rates. How much is PGBP income? PGBP income is 15 lakhs. Next, income from savings, income from other sources, interest on savings bank account, how much? 12,000. Well and good. So gross total income is 15 lakh 12,000 less chapter 6A deductions. Can you claim deduction under section 80C under optional tax rates? Yes. How much? 1,50,000 investment in public provident fund. Chapter 6 deductions are not available under default tax rates. You can claim deduction under section 80 TTA, interest on savings account, 10,000 under optional tax rates. Under default tax rates you cannot claim. So total income under optional tax rates is 15 lakh 12,000 minus 1 lakh 60,000, 13 lakh 52,000, 15 lakh 12,000. So under default tax rates, total income 15 lakh 12,000. What are tax rates? Up to 3 lakh tax amount is nil. Greater than 3 lakh up to 7 lakh tax rate is 5%, tax amount is 20,000. Greater than 7 lakh up to 10 lakh tax rate is 10%, tax amount is 30,000. Greater than 10 lakh up to 12 lakh tax rate is 15%, tax amount is 30,000. Above 15 lakh tax rate is 30%. So that means 12,000 into 30%, 3,600. How much is tax? 3,000 plus 600 plus 80,000, 83,600. To this you need to add HEC at the rate of 4%. 3344. 86,944 rounded off to 86,000. Next, optional. Total income is 13,52,000. Up to 2.5 lakh tax amount is nil. Greater than 2.5 lakh up to 5 lakh tax rate is 5%. 12,500. Greater than 5 lakh up to 10 lakh tax rate is 20%. Tax amount is 1 lakh. Above 10 lakh tax rate applicable is 30%. So 10 lakh into 30%. Much? No. 13 lakh 52,000 minus 10 lakh into 1 lakh 5,000. So tax is 2,18,100. To this you need to add HEC. It will be 226,820. Oh, under optional tax rates, tax is very high, so high, so it is not beneficial. It is beneficial to choose default tax rates 86,900. Correct. Here, it's small mistake. Greater than 12 lakh up to 15 lakh, tax rate is 20%. It is 60,000. Above 15 lakh, tax rate is 30%. That means how much? 12,000 into 30%. 3,000. So 2143,600. To this we need to add HEC at the rate of 4%. 149,344 rounded off to 149,300. So it is beneficial to pay under default tax rate. So that's it. That's all about MQP1. I hope you understood every problem, you understood every point. Thanks a lot.